You look at the screen and see one number, the price. It feels concrete, objective, almost factual. But that number is really the output of a process. It can move sharply even when the business did not change much overnight. That is why every asset price immediately creates two different questions. What is this thing worth based on the cash it can produce over time? And what will someone else be willing to pay for it in the market right now? Those two questions overlap, but they are not identical. One is an economic question. The other is a market question. Most confusion in investing starts when people treat them like the same question. Once you separate them, a lot of price action becomes easier to interpret. Price is the market-clearing transaction level right now. It is visible, quoted, updated, and emotionally powerful. Value is different. Value is an estimate of the present worth of future economic benefits. That estimate depends on what cash the asset can generate, how fast those cash flows can grow, and what return investors demand for waiting and taking risk. Because one number is a transaction and the other is an estimate, price can drift far away from value for meaningful stretches of time. In the short run, markets react to positioning, fear, optimism, forced selling, and liquidity. Over longer horizons, the underlying economics matter more. That is the intuition behind the old voting machine and weighing machine distinction. The market can vote emotionally for a while. Eventually, the business still has to weigh in through revenue, margins, reinvestment, and cash generation. So a useful mental habit is to ask whether you are looking at a temporary vote or a slower economic weighing process. If you want the cleanest starting point for value, you begin with discounted cash flow. In a constant growth simplification, value equals next period cash flow divided by required return minus growth. That denominator matters enormously. If expected cash flow rises, estimated value rises. If sustainable growth rises, estimated value can rise fast, especially when growth gets closer to the required return. But if the required return rises, the opposite happens. The spread between discount rate and growth widens, and estimated value can compress sharply. That is why changes in rates matter so much for valuation, even before company fundamentals visibly deteriorate. During 2022, the 10-year Treasury yield moved from roughly 1.5% to above 4%. A shift like that can materially compress valuation multiples across the market. This is why investors who focus only on earnings sometimes get blindsided. The business may be fine, and yet the market can still justify a lower multiple because the hurdle rate changed. So when people ask why prices moved, sometimes the answer is not lower cash flow. Sometimes the answer is simply a higher discount rate. And when the discount spread is thin to begin with, even a modest rate shock can have a large effect on estimated value. Now, move from one company to the broader market. Schiller's cyclically adjusted price-to-earnings ratio, or CAPE, smooths earnings over a decade in real terms. It is not designed to tell you what happens next week or next month. It is useful because it speaks to long-horizon starting conditions. Historically, when CAPE has been very high, subsequent 10-year real returns have tended to be lower. When it has been much lower, later long-run returns have tended to be stronger. That is why extreme valuation episodes matter. The dot-com peak was unusually expensive. The 2009 crisis low was much cheaper, and recent readings have again looked elevated relative to long-run history. What CAPE is really doing is telling you how optimistic the starting price already is relative to a smoothed earnings base. If a lot of optimism is already embedded, future returns have less room to surprise on the upside. But this is not a timing trigger. High valuation does not tell you when narrative, momentum, or liquidity will reverse. It only tells you the long-run odds are less favorable. That makes it a framing tool for patience and expectations, not a tactical entry signal. Fundamentals tell you what to discount. Risk pricing tells you how hard to discount it. The classic CAPM frame says required return equals the risk-free rate plus beta times the equity risk premium. That gives a simple way to think about why the same cash flow stream can deserve different valuations in different macro environments. If the risk-free rate rises, required return rises. If the market demands more compensation for risk, required return rises. If an asset carries higher market sensitivity, required return rises again. That already explains a lot of valuation movement. But real markets are messier than one beta line. That is why empirical models added size, value, profitability, investment, and momentum factors. Those models often fit history better. They are useful because they remind us that investors care about more than one dimension of risk and behavior. Still, none of them are perfect laws of nature. Factor premia can weaken, disappear, or reverse across periods. So the right posture is humility. Use the models as tools, not as guarantees. They help organize thinking, but they do not remove judgment. There is another layer people underestimate. At the margin, price is set by whoever must trade right now, not by whoever has the best spreadsheet. If willing buyers become more aggressive, price moves. If forced sellers need liquidity, price moves. If financing conditions loosen, investors can support higher prices. If funding tightens, prices can fall even before fundamentals fully change. Narrative matters here too. Stories can change willingness to pay long before accounting data catches up. When the story changes, capital often moves before the financial statements do. And this can become reflexive. A higher price can improve financing access. Improved financing can support investment capacity. That investment can support future cash flow. So sometimes price is not just reacting to fundamentals. Price can feed back into fundamentals. That does not mean price is always right. It means price can sometimes change the path of the business itself. This gives us a cleaner mental model. Layer 1 is fundamentals, future cash flow, growth, and the long-run economic anchor. Layer 2 is required return, rates, risk appetite, factor exposure, and macro regime. Layer 3 is market behavior, liquidity, flows, narrative, positioning, and reflexivity. Every observed price contains all three. The mistake is asking which layer always matters most. The better question is which layer dominates at the horizon you care about. Over days or weeks, market behavior can overwhelm everything else. Over intermediate horizons, changes in required return can reshape the whole valuation range. Over years, required return and business fundamentals matter much more. Over decades, the fundamentals usually do the heaviest lifting. That is why the same asset can look irrational to a trader and perfectly coherent to a long-term owner. They may simply be looking at different horizons and therefore different dominant layers. Apple is a good reminder that one company can move through very different pricing regimes. In the early 2000s, fear and multiple compression dominated. In the mid-2000s, product optimism and improving business economics drove repricing higher. In the financial crisis, broad liquidity stress crushed prices across the market, including strong businesses. Then from 2009 onward, the surge in product success and cash flow power pulled the long-run anchor sharply upward. The point is not that one formula predicted every move in Apple. The point is that different periods were dominated by different layers. Sometimes sentiment moved first. Sometimes macro discounting moved first. Sometimes fundamentals took over. If you try to explain the whole path with only one lens, the story feels inconsistent. If you let the dominant layer change over time, the path becomes much more coherent. That leads to the honest limits. Discounted cash flow inputs are estimated, not observed. Factor relationships are historical, not permanent. Sentiment can persist longer than rational investors expect, and some assets have much weaker cash flow anchors to begin with. So, useful models do not eliminate uncertainty. They only help you organize it better. They make the debate clearer, but they do not make the future certain. And that raises the natural next question. If prices can drift away from value for long periods, can disciplined investors reliably exploit that gap? Or are markets already efficient enough that persistent outperformance is much harder than it looks? That tension takes us directly into market efficiency. It is the next logical step once you understand how value, discount rates, and market behavior interact.